The situation in Brazil has become even more unhinged. The government now says it flushed $17 billion worth of its reserves just down the toilet in a matter of a couple days. And then the government officials come out and they're trying to blame speculators for the currency's plunge, which is never a good sign. It's instead another warning about how much the situation is escalating. Think about all the times you ever hear authorities blame those evil speculators. It's almost always right before the bottom falls out, pointing the finger elsewhere just before it does in order to cover everyone's butt on the way down. But Brazil's plight and several others that we've been highlighting raise a couple thorny questions that go way beyond the antics in Brasilia or Sao Paulo. Can the US really decouple from all this global mess? Or, turning it around, is the US part of the reason why this is all coming unglued in the first place? And to help answer those questions here, we're going to look at what stock markets are doing. And I don't mean the widespread sell-offs just this week. There have been signs of de-risking for months now, and not just back in August, though very much related to why there was in August. The reason why we had so many things show up in the summer was that there was an inflection underway during the spring. It shows up in stocks, the real economy, financials, currencies, even something like the Baltic Dry index, which has tumbled to a multi-year low, beginning that downtrend during the spring and summer. So what we get out of Brazil is one part of the globally synchronized process, an extreme version of it right now, but hardly an outlier. Stocks always want to go up. That's their default direction. So even when the stock markets start to say, okay, we're going to pause here and do so for a multi-month period, that's something to pay attention to, not just in terms of what the Eurodollar is doing, wrecking Brazil's currency. What we're seeing here is the Eurodollar flavor spilling over into even equities. And even the S&P 500 and Dow Jones Industrial, the NASDAQ in the US, maybe there's a touch of that involved in this week too. It wasn't about Jay Powell cutting fewer rates next year. It's worries about the global health and all of these signs that we're seeing all around the planet that suggest globally synchronized. But the latest from Brazil, we got more interventions right through the end of the week on Friday. So basically an entire week of intervention as the currency continued to plummet. Now it did come back on Friday from its low because short run, there are successes in short run periods when governments do intervene, especially when they intervene heavy, but it doesn't last because it really can't last. So the latest we got on Friday was the real gained as much as 1.4% on Friday, briefly erasing weekly losses after policymakers stepped in with both a spot sale and a credit line auction totaling a combined $7 billion. The reprieve comes after the central bank stepped in almost every day for the past week to try to meet a surge in demand for US dollars. It sold $8 billion in back-to-back spot auctions on Thursday alone, in the biggest daily sale of greenbacks since at least 1999. They spent about $17 billion in spot sales so far, and that's a big change from how Brazil used to handle its falling currency, something called the cupom cambial, something I've talked about before and written up extensively in Eurodollar University's deep dive analysis. But suffice to say, the situation has gotten to be untenable from Brazil's perspective, which is why we're seeing all of these interventions. And not only are we seeing interventions, we've got the last bastion of the government scoundrels blaming scoundrels that they claim are speculating unfairly against their currency. Finance Minister Fernando Haddad said the Brazilian real may be facing a, quote, speculative attack amid a sell-off sparked by mounting fiscal concerns, really economic concerns related to those fiscal concerns, as I said in my previous video. There may be speculative attacks, but I don't want to make a judgment about that as he's making a judgment about that by talking to the press, because the finance ministry works with fundamentals, Haddad told reporters in Brasilia on Wednesday, adding that he expects the currency to settle down, basically saying what every government official does in these situations. Not our fault, it's not the fundamentals. Where have we heard that before, Japan? It's not the fundamentals, it's those darn speculators. China, how many times does China talk about speculators and trying to deprive them of yuan in offshore markets? It's the offshore markets, all right, but it's funding, it's risk, it is absolutely fundamental. So the question we have is whether that fundamental is Brazil alone, or is Brazil starting to act up and look like de-risking that happens across the entire system, that's happening across the entire system. And so far, what's happening in Brazil is starting to spread inside Brazil to other financial components. The sell-off that sent the real plunging to a record low is now engulfing everything from stocks to local currency debt to even dollar bonds, Eurodollar, with traders even piling into hedges against a sovereign default. Market watchers say extraordinary measures on Tuesday, this past Tuesday, by the central bank to stem the currency slide are little more than a temporary fix, and they're not really that much, and warn that lawmakers' moves to water down a high-profile austerity package are likely to only add more to turmoil, which of course they are, because the issue isn't necessarily the budget deficit, but that's the primary angle that everyone's focused on, because that's the only thing that's propping up Brazil's economy as the globally synchronized system turns further and further in the wrong direction. And again, this is not just Brazil being upstream or downstream, depending on your perspective, of China. There's the entire global factors involved in this, as we keep seeing them in one place after another, after another, after another. You look at the Bovespa, Brazil's main stock exchange index. It had peaked, in the post-crisis, post-2008 era in 2010, 2011, before Eurodollar number 2 hit. Got it to around 70,000 for the index. And over the next 4 or 5 years into January of 2016, it continued to move lower and lower as Brazil really dumped into the depths of depression because of Eurodollar number 2, but really then Eurodollar number 3 that hit 2014 and 2015. We had the currency crisis in the real in 2013 that extended and got much worse in 2014 and 2015. In many ways, the fact that Bovespa index only got down to 40,000 at its low is a minor miracle, but then again, stocks aren't really about fundamentals anyway. From 2016, though, Brazilian stocks took off. After the depression was finally over, Eurodollar number 3 gave way to globally synchronized growth. Brazil's stock market, like its economy, while the economy began to at least bottom out, won't say it recovered, the stock market soared ahead, which is common for equities and share markets anywhere. By January of 2020, on the dawn of the pandemic, the Bovespa was back above 100,000, even though the economy never really actually recovered. It just stopped getting worse. So then you have the pandemic sell-off, and then the summer of 2021, after a sharp rise along with everyone else around the world, the Bovespa was up around 125,000, which was a record high. But then it fell under 100,000 again by the summer of 2022, and it kind of languished as the economy and recovery in Brazil did until Lula took office, as I mentioned previously, early 2023. And then 2023 was a very good year for Brazilian stocks until around December, January 2024, things began to turn around. So in many ways, the Brazilian stock market, at least from the Bovespa's perspective, has been sideways to lower since the end of last year, with a big dip in the middle of the year and another dip more recently. And you have to wonder, are stock market investors starting to feel the risks of a global economy that isn't what it's being sold as? That the downside of the supply shock, which is what we're really talking about here, is, pun intended, real. And like I said, I've already gone deep into the Brazilian story as well as some of these stock market stories too over at Eurodollar University's Deep Dive Analysis. And we've got a Christmas sale coming up tomorrow. Here's your chance to go deep into the money and macro world. We've also got Eurodollar University's AI that's going to be launched as part of the Deep Dive Analysis subscription. Best prices on all of those. We've also got membership deals as well as the daily briefing subscription. So check out our website, eurodollar.university, for all the details beginning Sunday, December 22nd. From a strictly American perspective, the idea of de-risking in the stock market or the globally synchronized downturn that's part of the supply shock downside, these seem to be foreign concepts, and I mean that in a couple different ways. Because the S&P 500, the NASDAQ, the Dow Jones Industrial Average, up until more recently, they seem to go up in a straight line, very briefly, at most very briefly, sidestepping what appear to be substantial issues elsewhere. Nothing stops the U.S. stock market because it can't be because of the U.S. economy. As we all know, there's a reason why we just had a change election. The economy is terrible. So whatever it is with the U.S. stock market, it seems like it is detached from everything up to including the rest of the world, starting with Brazil. But when you start looking and poking around at some of the details, then you start to see the similarities between what we're seeing in Brazil and even the results that are coming out in American equities, American focused equities. I talked about this last month in November. Warren Buffett, Berkshire Hathaway, raising tons of cash, selling stocks like he does normally, but then not reinvesting the proceeds either in the rest of the stock market or buying back his own shares. And a lot of people have continued to ask questions. Of course, we don't have any answers because we have to wait for the next Berkshire Hathaway report. But everybody's been asking questions. Why is Berkshire Hathaway and Warren Buffett stockpiling so much cash? Why are they only selling and not buying? Is Buffett trying to tell us something? Are they de-risking? At $325 billion, cash now accounts for 28% of Berkshire's asset value, the highest level since at least 1990. And it has left his followers and pretty much everyone else attempting to pinpoint the motivation for the sale, or really sales, plural. Some investors and analysts believe Buffett, who trained under legendary investor Benjamin Graham, first at Columbia University and then at Graham's investment firm, is sticking to his principles. Others believe something else is afoot, given Buffett's praise for Apple over the years and a dearth of other investment opportunities, which the 94-year-old has repeatedly lamented. They have been left asking if Buffett is creating a runway for his successor or if he sees a crisis on the horizon, giving him reason to raise cash. And Buffett's not the only one where we see selling. I've talked about this too. In fact, in the same video, the Philadelphia Semiconductor Index, which is a highly cyclical sensitive index where, consumer electronics are a big part of it. So global consumer electronics cycle can sometimes find its way into something like the Philly Semiconductor Index. Up until July and really August, because it continued to the sell-off in the carry trade in early August, the SOX, as it's called, and the S&P 500 were in lockstep, which again shows that they're not really trading on fundamentals. That's just stock market behavior being stock market behavior. So when you start to see those two diverge, as they did in August, after the initial decline, the plunge in early August, the carry trade, everything else, both of them began to rebound, but the S&P 500 kept rebounding and going farther, while the Philadelphia Semiconductor Index did not. So the SOX has been sideways to now lower again, while the S&P 500 has been almost straight up until the most recent week. So it begs the question, what changed around, well, this seems here August, but when you look at the other correlations with the semiconductor index, such as the Nikkei in Japan, you see that the Philadelphia Semiconductor Index and all the rest of the global indexes were highly synchronized up until around the middle part of this year. When you look at the Nikkei index, the Nikkei actually hit a big high in March and then it was slightly lower to sideways. It got a little bit of a bump in July where it actually hit its most recent record high. And that's where it really picked up the correlation with the SOX index since July. So it really started in March and then April, June, and into July, but then a real big correlation from the summertime right up until the present day. So why is the SOX trading more like Japanese stocks than the S&P 500? Well, this March inflection shows up in a whole lot of places. So you have a cyclical indicator in the Philadelphia Semiconductor, the SOX index. You've got Japanese stocks that are highly susceptible to conditions in global economy, global trade. Japan Inc. is still there on the Nikkei. So a couple of those look like a fair amount of de-risking from the middle part of the year too. And that fits with a whole bunch of inflections that we see all over the system as well. One of those I want to highlight here, the Baltic Dry Index. This is a shipping index that's, as the name implies, pertains to shipments of dry goods like coal and iron ore, raw materials that are important in everything that's happening in the global economy. And the Baltic Dry just this week fell again to its lowest level since last July. There's some seasonality involved in the index. It's always usually down at the end of the year as things start to tail off because of winter. There's more than the usual seasonality this time compared to certainly last year. It's starting to look more like the winter of 2022, which is not a good sign because that was China lockdowns, everything looking really bad. In fact, the Baltic Dry very nearly hit a record low in early 2023 for how little demand there was for shipping. And look at where the Baltic Dry inflection really comes in. It comes in the middle of the year, March, and then the summertime. The downtrend starts to develop in the middle part of the year, and then gets more completely developed toward the end. So if stock markets are de-risking, they have every reason to do so because the fundamentals in the real economy are raising the risks that even stock market investors might have to pay attention to. Even though stocks always want to go up, that's their default position, there are these times, like we see in Brazil, where even parts of the stock market, and eventually more parts of the stock market, have to pay attention to fundamentals in the global economy. Remember what Fitch said about Brazil, and I brought this up in my previous video. However, strong growth in Brazil has been accompanied by weaker than expected fiscal performance relative to the original 2024 budget projection. Economic outperformance may partly result from the loose fiscal position, which they're basically admitting government spending is the reason why Brazil's economy looks as good as it does. But if the fiscal performance is weak when growth is strong, it could definitely deteriorate further in an unexpected slowdown. And that unexpected slowdown is, first of all, not really unexpected. We've been seeing it coming from a lot of different angles for quite a period of time already. But that slowdown is more than just a future thing. It's happening right now. And it leads to a whole bunch of negative consequences, including de-risking that we're seeing all across the board. And this includes, by the way, the U.S. To answer the question that I raised at the beginning of this video, is the U.S. decoupling from the rest of the world as it falls further and further into this mess? Or is the U.S. part of these mess to begin with? The answer is the latter. The U.S. is not decoupling. We see that especially in more recent labor market indications that go back to inflections around March and April. As we see these develop, especially in the summertime, July, the CPI, I mentioned the June CPI that came out in July, a big one that shows up everywhere, including the peak in the Nikkei, as well as the Philadelphia Semiconductor Index. The idea that consumer prices at that time were breaking down so much as a reflection of the U.S. weakening in tandem with the rest of the global economy. It may not be exactly synchronized in terms of timing and degree, but you can see it developing in the same way because it is synchronized. And one more note on the U.S. labor market, more recent data, not only has the adjusted unemployment rate really shot up, even the official numbers from the BLS, the job finding rate, which is something I'll talk about in tomorrow's video with Steve, the job finding rate has absolutely plunged, suggesting that the labor market, therefore overall economic conditions in the U.S., are beginning to more and more clearly resemble what we're seeing around the rest of the world. These risks that are rising in all of these different ways. In Brazil, it's fiscal factors for an economy that's really weak. It's weak without the government spending, and markets are getting the sense that's the case. But behind everything, it's the downside of the supply shock. The idea, the real idea, the fundamentals that there wasn't actually a recovery in 2021 and 2022, the first half of 2022. Instead, it was artificial. It was fake. It was an illusion created by not just prices, but also government spending. And the risks of that illusion becoming clear are also becoming more clear in even financial markets like equities. There is de-risking here. We see that in a lot of ways. Even U.S. stocks, from Berkshire Hathaway and Warren Buffett, maybe, probably, to financial indications, market curves, behavior there, Chinese bond yields that continue to plunge, the Baltic Dry, the semiconductor index. De-risking is becoming more prevalent as a theme in a lot of these different places as we continue to see all of these things pop up here, there, and everywhere. The downside of the supply shock is very real, and it's going to be a real wake-up call to not just Brazil and its real. Brazil's currency story is really a story about how Brazil is trying to handle the downside of the supply shock, and I went over all the details in the video link below. As always, thank you very much for joining me. Check out Eurodollar University's Christmas sale coming up this Sunday. Thanks to Eurodollar University members and subscribers, and until next time, take care.